And welcome everybody to Smart Investing. So I owe you guys a few videos since I didn't do the two from yesterday. So here are the rest of the videos. And we're going to start off with the three banking services sector stocks that I owe you guys. There's many more to come. So stay tuned for like back-to-back videos for today. Today is June 20th, 2023. It is 4:31 p.m. Markets are closed. And it's been a wild ride in the markets today. They were downtrending ever since the open. And then right about the afternoon mark, around 12, things started to stay kind of flat after they went up slightly. And then all of a sudden it started to do an uptrend again. Weird. Very, very weird. So obviously, again, the Nasdaq pushes all those stocks up for the uptrend. So aside from that, let's see how far the banking services sector has gone. We'll look into that real quick. Well, along with the ticker symbol ELVT, that will be the first stock that we start off with. So let's jump right into that. We'll see real quick, just jump into the consumer lending or banking services sector. So clicking on the banking services sector, we see here today decline 370 versus 114. So really big win for the Bears. Not much going on for the Bulls when it comes to the banking services sector. So again, the highest gain was 18%. The highest lost was 27%. So that can give you a really big perspective as to how big these losses are. And again, I know these stock prices are cheap. So the cheaper they are, no matter the percentage, they're just small losses. But again, they can accumulate as time goes on when declines continue. And then it's hard to kind of gain momentum on the uptrend when banks overall are still doing bad. So that's just an overall look in the banking sector. I thought I'd just feed that back to you guys. I've never really thought about showing you that, but that was just a sneak peek since I have the whole week off and have some time and, trying to give you some extra goodies now that, I have more time, I guess, for the videos. So let's move on to ELVT. So first thing that is going on, the stock price is super cheap. I mean, under $2. Market cap is not being respected by Wall Street standards, as we can see. Decent volume and 52-week high and low. Awful range for the year. Earnings are horrible as well. No dividend as well. I mean, it's just an all-around awful stock. I don't see any reason for this stock to even go up. They would need like a miracle or like a very big turnaround for the share price going on. Looking at the chart the past 5 years, looks like in a hard downtrend. You see this leg going down, then that confirmation right here. And about like the same year in 2018, so you got that one move down and then continuation in October. It just even furthered that continuation. So with that confirmation, basically that second leg confirming it to go down, you can see it tried to stay flat, and then we were trying to see what the next trend was. It started to go up, not go up the 200 EMA, just missed it by a little bit. Then it furthered down to the downtrend with further confirmation. Started to go up again and try to get that flat range again, still missing the 200 EMA for even a longer term. And then we can see here another year going by from 2021 to 2022, stayed flat, still under the 200 EMA. And then we can see here the start of 2022, going into 2023, and even further decline. So you would have lost right here over 70% in this stock. I'm sure a lot of people have not invested in this stock. God willing that they did not. So anyhow, cheaper is not always better. I mean, just by looking at it, I mean, you would have just been declining and declining and declining in losses. How much punishment is enough? So definitely not a good stock to even jump into. I don't know why these ratings are high. Growth is at an 8. They rated this. Overall rating 3 out of 5. I rate this a 1. If I could rate it a 0, I would. We have obviously no income, so that's a 0. Average rating 5.63. I wouldn't even rate this above a 3. I mean, all these numbers are pretty much awful. Nobody's really looking at this stock just based off these numbers here, and I don't really think I should go any more further into this stock. And aside from that, this stock is in the industry for consumer lending, just so you guys know. Consumer lending is just strictly one strategy for their business model. The reason I prefer consumer lending versus banking is just because you can still diversify with the same business model, and it's hard for it to grow because the strategy is so limited as to how you want to make money in this kind of company. But the good thing is that there's not a lot of competition when it comes to consumer lending, and strictly just consumer lending. So anyhow, this stock is a no from me. Given the numbers and all the analysis that I did, yeah, like don't even don't even take anybody's word for it. The numbers are there. Looking at the facts, and if anybody tells you otherwise, I call BS. So moving on to the next one is TCFC. I believe this. No, this ain't the one. I know one of these stocks got delisted, but anyhow, we're gonna go over TCFC. So the last 5 years, you can see a loss of 13%, but we're going to jump right into the first page first. We have here a market cap of 165 million. Pretty weak and not respected by Wall Street. Just in case you guys know, this is not the letter E. I'm just trying to separate this so you guys can see, what I'm looking at. I'm highlighting that, category or number or topic, so you guys are aware and you guys can actually see what I'm talking about and kind of go step by step with me. And I'm pretty much kind of walking you through my analysis and my evaluations to see, how I'm actually doing this. So moving on to the first page. 52-week high and 52-week low. Decent range. We're still stuck in the middle. We have here dividend of 0.7, yield at 2.4. Earnings seem pretty strong for a market cap like that. Price to book and price to sales is at 2. Price to book is below 1. Very cheap. Then we have here the charting. Long term, we have a big downtrend trying to have a leg up. pretty much a slight uptrend for 1 or 2 years, but not much movement for those 2 years. Then a big downtrend here, and then another leg down. That's going to solidify the long-term downtrend. As you can see, it's under the 200 EMA. So confirmation that states that any movement up is just a fake rally. So we have here, going on to the analysis, we have here, it is at 7.8, which is the highest rating for the quants. Overall rating is 4 out of 5. It's hard to believe. So anyways, quality is at 7.8. I want to see that in action. Let's see what let's see why there's so much quality. They're paying dividends, rising dividends. So we have here 15 cents in 2021, 17 cents in 2022, and still 17 cents in 2023. So they have not given a raise as of yet. They have done a few splits, 3 for 2, 3 for 2, 3 for 2, and that was in repeated years in early 2000s. So we have in December of 2004, December 2005, and November of 2006, those splits. So if you own those shares before those years, yes, you have gotten more shares, and the price is pretty much the same to you. You just got more shares, but the thing is that your percentage in ownership is lower if you decide to, consider doing this for the long term. So anyhow, aside from that, moving on to the financials, let's see what they have. Do some annual, some annual numbers here. So looking at the earnings, we're looking at this. So we have here a beat, a miss, a beat, and then Q2. They are estimating between, I don't know, that looks like $1.21. So that's actually $1.19. I was guesstimating, but those numbers should be coming in late July, as you can see here, from the 24th to the 28th. Now, looking at ROA, that's pretty low. Those are decent numbers for 2022. I'm just looking at 2022 numbers and like a real quick peek at this graph. That's pretty much all I'm doing for all these key indicators. Not bad for the earnings. Net margins are pretty high. Typical debt, and that's pretty much it. I typically don't look at these three. That can change pretty frequently, and it's just not too important to me. So moving on to the income statement, we have just a slight increase. Then we have revenue, slight increase, not bad. Gonna skip to the cash flow. So we have 10, 11, 12, so 125. Wow. So they are about negative 120 million in cash flow. So this company has work to do. I mean, it sucks to see that, it looks like, I don't even know what to call this page, but from basic numbers, they look okay. And then all of a sudden, when I'm looking at the financials, they look okay. Then, sometimes, especially for the banks, I'm thinking they're going to do okay. And then when I get to the cash flow and I see the negative, it's like it just cancels everything like we just went over. But it's still important. So, I mean, it sucks to see that, but the stock is not good at all. It doesn't look good. And again, I'm a strong believer if a good company, a good service, or a good product continues to be good, then it should stay good. Uh, Sometimes a business uh, does well on its own, if that makes any sense. Sometimes a business can take care of itself, depending on the business model and leadership and management. Sometimes a lot Wall Street really cares about that. They're like 100% on that, but it just really depends. To me, it really depends. I don't think Wall Street is that critical. I think that's why, honestly, I'm a little bit more accurate. Uh, I'm a little bit more hands on, and I look into more critical stuff than Wall Street because Wall Street is comfortable. Think about it. If you're making good money in the stock market, let's say from an advisor, and then all of a sudden, after let's say 3 years, you're already have a consistent gain, and then your broker or your advisor or whoever's making you money, you're doing everything right. You're putting in money and they're making money for you. But then the thing is that all of a sudden you get into this zone where you're feeling comfortable. So what happens? You become a little bit more laid back. You're getting too comfortable. You're dismissing things that you shouldn't be. And then when things turn for the wrong, when things turn bad or start down trending, all of a sudden people flip out. And that's just part of the game because when you're looking to market as much as I do, like you're looking at this every day, like you live for this. This is not something where you just look at every once in a while and whatever. Yeah, it's fine to take a break, but even when you're not looking at it, you're still thinking about it. You're still wondering like what's going on in the market, what's going on in the business today, and whatever. So, anyways, I just wanted to throw that out there because anything can happen at any given time, at any second. So, I'm just I like what I do and I'm good at what I do, and I'm on top of the ball, as they say. So, looking at this stock, ticker symbol BBAR, market cap would seem respected by Wall Street. Volume 821K. I would say that's pretty active for a pretty cheap stock. I see the word Argentina in there, so I'm betting that this company has the headquarters in Argentina, which would be in South America. So what I'm saying is that this is an international company. Just with that alone, Wall Street does not like international companies. When it comes to Europe, apparently it's a different story. Depending on the market cap, very, very selective on European stocks. I'm gonna call that out there. I call BS. So I think that's pretty much being one-sided. Just because you look or at a certain country or you like a certain country doesn't mean they're necessarily good. There's always good and bad things and neutral things in any kind of situation or any kind of interest. It just has to do with uh, your evaluation and how much are you willing to look into it before you actually make a final answer. So this is one of the many reasons I don't like Wall Street. And even if they wanted me and paid me to be a analyst or junior analyst, whatever, or I don't know, I could care less about Wall Street, just because the way they are. So anyhow, moving on to the stock. Earnings. This is very weird earnings. 52-week high and low. Dividend is only a penny. Dividend yield is awful. I'm still trying to grasp the fact 236 earnings just doesn't seem correct. Looking at the last 5 years, you would have lost about a little bit over half your money. It's starting to go in an uptrend. This past the 200 EMA. Very, very weird. The 200 EMA, take a note at that. So that was at $4.55. Now we're gonna go into a lower time frame. So they're paying monthly dividends or something now, or did they pay that? Oh no, they have not paid that way. But for some reason in 2022, the second half, they decided to pay monthly dividends for 6 months straight. Who knows how, who knows why, who knows when, but it's all said and done. So anyhow, at 455, let's see, let me look at 455. Let's say about there. So we have two legs up. So confirmation that it has gone up again. Now, for people to keep being interested in the stock, it just has to go above 3 cents. Above 3 cents for this stock. Can you believe that? Near its 52-week high. And again, that's still a pretty cheap stock, in my opinion. So again, this will be a good day trading stock. I wouldn't be surprised if tomorrow this stock would have more volume than it does have it today. So if I'm a betting man, I would bet that tomorrow this stock might be looked at. If it breaks new highs, it's definitely going to be above 800,000 in volume. Where is I don't have any quant ratings, so it's not giving me anything. I'm still trying to figure out why it has over 200 earnings. This has to be in a different kind of currency. I mean, Q3 2021, Q3, that was the last one, and then the earliest one that they've given me is 2021. So inaccuracy, not on my end, but what the information is being presented to me. So we're going to look at some annual numbers here. Decent for the equity. ROA is trash. Net margins are okay. Pretty decent for the debt. Better than other counterparts. So this is because the earnings are in Argentine dollars, and I think that's why the earnings are so big, because they're not converted into American dollars. That's why the earnings are so high. If they were converted into American dollars, this would be a whole new ball game. Usually they are excuse me, they are converted, so I don't know why. Anyhow, moving on to the net income, looks okay. Then we have revenue, looks okay. Then we are off to the races for the cash flow. Let's see how this works out. So they have negative cash flow. So another awful stock. And we're going to call that the end of this video. So none of these stocks are any good. And the only one that is decent enough for short term, which would be a day trade. So maybe for the week, the rest of the week, this ticker symbol BBAR. I don't know if I should watch list it. I doubt it. But who knows? Anything can happen. I'm not adding it to the watch list. I got other stocks that I've been watching day to day. I don't have a big list, but still, I want to try to take advantage of the day trading since I'm off this week. So thank you guys for watching. I'll see you guys real soon. Real soon. I'm going to make another video right after this. Drink some water and take a little break. And I'll see you guys real soon. Thanks for watching, and Take care.